Hey, what's up guys? This is Taylor Horton. I'm the Vice President of Directional Options Strategies here at Simpler Trading, and in today's video we're going to talk about choosing expiration dates, which, guys, you want to keep this simple. I think for a lot of newer options traders, obviously at first options can be a little bit complicated, right? A little bit complex, there's a lot of layers, and when it comes to taking an options trade, one of the decisions we have to make is how much time do I give this trade till expiration. But I think we want to keep that simple. So at the end of the day, choosing expiration really just comes down to a basic understanding of how options function, which we'll talk a little bit about in this video. But for me, guys, here's a few guidelines, and really my choice of expiration date, that's going to be dictated by the time frame of the setup I'm focusing on. So for example, what I mean is, say I'm taking a trade based off of a weekly chart, nice bullish weekly squeeze. I'm going to give that trade a lot more time till expiration than I would if I'm taking a trade based off of, say, a 15 or a 30-minute chart. So in terms of a few guidelines here, for my weekly setups, typically going to give my trades 6 to 8 weeks till expiration. For my daily setups, typically looking for about 2 to 4 weeks to expiration, so upwards of 30 days. Then for lower time frames, say I'm working with a 4-hour chart. That could be 5 to 10 days, and as the time frame gets lower, typically so does the amount of time I give that trade till expiration. And then one question you might have is, what about the 0-day till expiration options, which I would say this year is certainly getting more popular. For example, you got the S&P, the SPX, which now has 0-day expiration options Monday through Friday. So it used to be that you had the Monday, the Wednesday, the Friday. Now you got Monday through Friday. So there are going to be times, and there's going to be certain markets where looking for day trades or looking for 0-day till expiration trades does make a lot of sense. So I will do that from time to time. Those can make for nice, weekly income trades. And we'll take a look at a few examples here in this video. But a few things to remember, guys. Like I mentioned, just some basic, some options basics. Keep in mind, options are a depreciating asset. So options lose value over the course of time. How much time is left on an option until expiration, that's going to dictate how quickly or slowly that option loses value. And as we all know, or most of you know, that's a process we refer to as premium decay. Now, premium decay can work in your favor. Typically, for me, it's working in my favor, is I like to sell credit spreads. Say you're buying calls or you're doing out-the-money debit spreads, what you have to understand is that you're fighting against the clock. Right? With certain option strategies, theta decay, premium decay, time decay is working against you. So that's where you're going to have a good understanding of that. That way you're choosing the appropriate time till expiration. Say you're selling credit spreads like I like to do, then the premium decay is working in your favor. So if I sell a put credit spread that expires in 3 days, of course there's a chance I'll collect my premium quicker, but that trade's also going to be a little bit riskier. If I sell a credit spread that expires in 300 days, it's going to come in a little bit slower. So we're looking for a good balance, guys, but going back to slide 1 here, these are my basic guidelines, and in terms of choosing our time till expiration based on the setup, I want to pull up a few charts here and give you a few examples and give you a sense of what I'm referring to. So a few examples here, and we're going to look at an energy stock, Dominion Energy, ticker D. So here's the options chain, guys, and you'll see our different choices of expiration dates. So for stocks like D, this is an example of a stock where you only have monthly expiration. So you have options that expire on June 17th, you got options that expire on July 15th, October 21st, January 20th, so on and so on. So in terms of choosing which expiration date, again, that's going to come down to what time frame are you focusing on. So in this example, and as a lot of you know, I like to focus on squeezes. So really, it's pretty simple for me. Say I'm going to focus on this weekly squeeze. Well, in terms of picking a time till expiration, there's a few things we got to take into consideration. One thing to take into consideration is that a weekly squeeze, this could take another 2 to 3 to 4 plus weeks just to get moving. Then when it finally fires, that could take another 2 to 3 to 4 to 5 weeks to really release all that energy to the upside. So being that this could take weeks on end to develop, and then once a move starts, being that it could take weeks on end for that move to finish, it wouldn't make too much sense here to jump into this trade giving it 5 to 10 days till expiration. So going back to the options chain here, if I'm going to base a trade on a weekly chart, something like July 15th or October 21st, those are my best options here. Going out to January 2024, obviously it's way too much time. Going with the June 17th, which expires in 11 days does not give that weekly chart enough time to play out and potentially fire the squeeze. So with a weekly chart, we're going to go with usually as much time till expiration as possible, but we're trying to strike a balance here. So like I mentioned back there in the slides, I really think 6 to 8 weeks of the weekly charts, that's a good balance. So here's a nice daily chart in AEP. And we also have a daily squeeze, so same concept. A daily squeeze might take a week to 2 weeks to get going, and then once a move takes place, it could take a week to 2 weeks to release all that energy. So if I like the daily chart, I want to make sure I'm taking my options trade, whether it's a call debit spread, whether I'm selling put credit spreads. I want to make sure I'm going with an expiration date that gives this setup enough time to develop and unfold. So if we go to the options chain here for AEP, we're probably going to go with July 15th. Daily setup's looking for about 2 to 4 weeks. I think in this instance, you're striking a pretty good balance there going with the July 15th. That gives you 40 days to expiration, so whether we do a credit spread or we buy calls here, 40 days gives that daily structure plenty of time to develop and eventually fire in our favor. So with a daily chart, we're looking for, I think the sweet spot's about 30 days. More often than not, I tend to end up around 30 days with these daily charts. And now we've got a setup that I like on the hourly chart with an hourly squeeze on the S&P 500. Right, now what's nice about this is, since it's the SPX, this is where we got some flexibility. So if I pull up the options chain here for SPX, you'll notice we have options that expire today, options that expire tomorrow, right? So Monday, Tuesday, Wednesday, Thursday, Friday, we got a lot to work with here. So, being that we're working with an hourly chart here, same concept applies, right? It's an hourly chart, but it's still a squeeze. So I want to make sure I'm going to take a trade here and give it enough time to develop and then potentially unfold in my favor. But of course, being that it's an hourly chart, things do tend to unfold a little bit quicker, of course. So based on my guidelines, I think anything from 4 to 10 days to expiration, that usually works out pretty well with these 30-minute, 60-minute squeezes. So here's a trade I actually have on right now. Based on that hourly squeeze, I sold a put credit spread that expires in 4 days. Now, going back to what I mentioned earlier about the function of options, just kind of some core basics here, I sold the put credit spread. So I'm short that 4100 put. Now the premium decay is working in my favor. This only has 4 days to expiration. So this is an example of a trade where that premium decay, that clock ticking, it's working in my favor because I'm short that option. Right now, the 4100 put's going for like $35 per contract. Between now and Friday, between now and expiration, 4 days away, as long as the S&Ps hold above 4100, that option's going to lose value every day. And that's going right into my pocket. But now imagine instead I did the same exact trade, right? Same put credit spread, but I did that for October expiration. Well, if I give that trade almost 100 plus days till expiration, yeah, you still have some premium decay, but it's going to take way longer. The options that only have 4 days of life left to them, they're going to put that premium in your pocket way quicker than an option that has 100 plus days to expiration. So that's again where I've got my guidelines. Through trial and error, you figure out what you like as far as what you want to do for a weekly chart, what you want to do for a 30-minute chart. But at the end of the day, it's kind of that relationship between a good setup, the right strategy, and enough time till expiration. Doing so with the understanding of how time affects your trade. If you're long out-the-money options, then time is working against you. If you're going to buy an out-the-money call, you might want to take consideration of giving that trade plenty of time. Where if you're going to sell credit spreads, that's when that premium decay is working in your favor. So if you're looking at a 30-minute chart, that's where it makes more sense to sell the puts that expire in a few days versus 50 days out. if I'm going to buy the out the money calls here, if I'm going to buy the 4,200 calls because the clock is ticking against me, that's where I'm going to give it a little bit more time. So as a quick recap here, guys, and again, these are just my guidelines. This is what I found to work over time. But when I'm taking trades based off of weekly setups, 6 to 8 weeks till expiration. For daily setups, 2 to 4 weeks to expiration. And then for my 4-hour setups in the lower time frames, anywhere from 3 to 10 days to expiration. So I hope you all found this helpful. I know we kind of went through things pretty quick there, but like I mentioned, we want to keep it simple, and all you really need is that basic understanding. Options are a depreciating asset. That depreciation is either working in your favor or against you, and how much time you give your trade to, until expiration, how much time you give your trade to work out will dictate how quickly that premium decay works in your favor or is going against you. So, hope you all found this helpful, and we will talk to you in the next one. What's up, traders? This is Taylor from Simpler Trading. I wanted to thank you for watching our video, and if you liked the video, go on ahead and comment down below, hit that like button, and make sure you're subscribed and hit that bell icon to get a notification anytime we upload our next video. And of course, if you want to watch us trade live in real time with our own money, check us out at simplertrading.com. Until then, trade safe, and I'll catch you in the next video.